Disclaimer: all my videos are for educational purposes only. I am teaching and explaining investment trading to everyone, but I am not giving out any advice. All investments are subject to market risks, so please evaluate carefully before you invest, as you may lose your investment.
Hey guys, welcome back to part 3 of this video. So today's video is going to be based on IPOs, which is the traditional route most companies take to go public. So before I talk about today's video, I just want to say that if you guys haven't already seen part 1 and part 2 of this video, part 1 based on mergers and part 2 based on acquisitions, then I would highly suggest you do check them out. Either you skip onto those videos right now and then come back for this video, or you check them out after this video is done. Either ways, I've put info cards on top, so you can definitely check them out whenever. But I would highly suggest that you do check them out, because mergers will teach you all about why companies feel that they should merge with another company, the reasons which go behind them, and some examples. As well as the same for acquisitions. I talked about why companies feel the need to acquire other companies, the reasons which go behind them, as well as some examples in the recent past. Now, one thing to note which is really interesting is that when I uploaded my video on acquisitions last Wednesday, that was the same day Amazon agreed to acquire MGM Studios for $8.45 billion. So it's really interesting to see that the same day I decided to launch my video on acquisitions was the same day when Amazon agreed to acquire MGM Studios to boost their Amazon Prime Video platform. So I would suggest that you do check it out. Now, coming up to today's video on IPOs, as I mentioned earlier, it's the traditional route most companies take to go public and to sell their shares to the general market. So in this video, I'm going to be talking about a brief explanation of IPOs, what IPOs are, some criteria companies need to fulfill before they can have this IPO launch of theirs. And I am going to be talking a lot about the difference between an IPO and a SPAC, which I had already mentioned that I was going to do in this video in my previous video on acquisitions. So jumping in for today's video, I'm first going to talk about what exactly is an IPO. Hey guys, sorry to interrupt, but before we talk about what exactly an IPO is, I want to do another quiz round. So I was really happy to see the responses I got for my last quiz round on my video on acquisitions. So now I want to keep that as a regular thing. But I was a little saddened that I didn't get too many responses, and I think that's probably my fault as I kept the quiz round too late in the video. So now I'm going to be keeping all my quiz rounds at the start of my videos. So since today's topic is on IPOs, my questions is also going to be on the same topic. So for today's video, I want you guys as the audience to research and to find some companies where their initial price, which they set when they debuted on the stock exchange, is higher than what they are trading at now. Or in other words, the stock price which some companies are trading at is lower than when they had first debuted on the stock exchange. So I open up this question to you as my audience, and I would love to see some companies you guys can research and find about. So do hit me down in the comments and let's see how many of you can get how many right. So now let's first move on and figure out what exactly is an IPO. So an IPO is an initial public offering. Now, an IPO is a process of offering shares of a private corporation to the general public in a new stock issuance. So basically what this means is that this allows a previously private company to sell and offer up its shares to the general market for the first time ever. Now, this allows the company to either raise additional funds through the sale of the shares in this IPO round, or otherwise to allow anyone and everyone to be an investor in this company, or otherwise to finally get a public valuation of their company. Now, an IPO can be a very big step for the company as it provides the company with access to raising a lot more money, and that can give the company a greater ability to grow and to expand. As well as this allows the general public to invest in the company's future as well as to reap benefits from the company's profits. Now, I hope you've understood a little bit about IPOs and what they are. Now, let's move on and now find out the criteria the SEC and the stock exchanges impose for a company before they go public. So now let's move on and talk about some basic criteria companies have to fulfill when they want to go for an IPO. So even though I'm going to be talking about some very basic criteria, I hope from that you can understand just how drawn out and how rigorous this process of applying for an IPO is. So before anything, the company which wants to apply for an IPO first has to fill out a registration statement with the SEC, which is the Security and Exchange Commission. And this is just a registration statement to say that it wants to apply for an IPO. And only once the SEC approves this registration statement, that is only when the company can move forward with this application of an IPO. Now, on the NASDAQ, which is one stock exchange, when a company wants to IPO on that stock exchange, they have a very specific and very interesting criteria which I want to discuss with you guys. So what the NASDAQ says is that they have this criteria where they want a company to fulfill any one of 4 criteria which they base on earnings, cash flow, market cap or market valuation, and shareholders' equity. So now talking about earnings first, NASDAQ states that the company which wants to go for an IPO needs to have had earnings of at least $11 million in the past 3 years, and in none of these years should they have had a net loss of earnings. Now, talking about cash flow, the company's cash flow for the past 3 years should have been at least $27.5 million, and in none of these 3 years should they have had a negative cash flow. Now, talking about market capitalization, NASDAQ states that the company's market cap on an average for the past 1 year should have been at least $850 million. And for the last one, what they state is for the equity is that the company should have at least 55 million in shareholders' equity, meaning that all the investors who have invested money in that company, the total sum of investments should be at least $55 million or more. So as you can understand from this basic criteria only, why a lot of companies now in this day and age are favoring going through an SPAC merger, which I'm going to be talking about in my next segment. So now for the last thing on our checklist, the difference between an IPO and a SPAC. Now, even though both of them are routes for a company to go public, however, they are very different in terms of their approach. Now, I'll explain what I mean. So, in an IPO, what happens is that when they debut, the company fixes the share price it wants to debut at, which is called the IPO price, the initial public offering price, as well as they define their market valuation when they enter because of the total amount of shares they have as well as the IPO price they've set. Whereas in an SPAC, what happens is it is completely different. What happens is that since the SPAC is a blank check company and the investors have just put a lot of money into them, the value of the SPAC is the amount of money which is put into it. And then when a company looking to go public acquires this SPAC, then the shares of the SPAC are adjusted to match with the valuation of the new company. So as an example, let's say the SPAC has a valuation of $500 million. Then the new company looking to go public has a value of $3 billion. So that is a 6 times difference. So the shares of the SPAC are boosted 6 times to match with the valuation of the new company. Now, the major difference and the reason why now a lot of companies in this day and age are now choosing to go with the SPAC route versus an IPO is that in an IPO, as I talked about in my previous segment, when a company wants to go public via an IPO, then it has to go through a lot of rigorous checks from the SEC and the stock exchange. And the SEC checks the company's fundamentals, the financials, all of that. Whereas in an SPAC, the SEC does check through the SPAC definitely, but how much can you check on a blank check company which just has money? So they do not have that many checks to do on the SPAC. And when the new company looking to go public acquires this SPAC, the SEC is not able to do that many checks on the company's fundamentals, financials, and all that. And that is why it's sometimes very risky to go for this SPAC route, but a lot of companies now are thinking that this is by far one of the best methods. So I hope you've understood the major difference between an IPO and a SPAC, and you should definitely be cautious about investing at the early stage of an IPO as well as an SPAC merger, because you need to know what exactly the company's fundamentals are before you invest into them. Hey guys, I really feel bad for ending this video here, but I think it would be nice to take a break. But I really hope you've enjoyed this video, and I hope you've got to learn a lot about IPOs, what they are, some basic criteria, but to understand exactly how drawn out and rigorous the process of IPOs are, and you've understood the basic difference between an IPO and a SPAC. But nonetheless, you can always hit me up on Insta or on YouTube and tell me any questions you have. But I hope you've had at least a basic understanding of all of this. Now, in my next video, it's going to be a very short video because I'm just going to be talking about some few terminologies you need to know about after a company goes public. So do look forward to my next video. Until then, stay tuned, take care, thanks for watching, and I'll see you in the next video.